Everyone is already notified of the session that it will start 7 p.m. UAE time. I will go just the very first 5 minutes with the review of what we have gone through, mainly the last half an hour. Okay, we were in this place. We said that companies issues annual reports, and the annual reports, they have the financial statements, and the major three interrelated primary financial accounting statements are statement of financial position that we call balance sheet, and the other one is income statement, and the third one is cash flow statement. Okay. And we came across the balance sheet, which is with the magic formula: assets should be equal to liabilities and equity capital. And that's why they call it balance sheet. And we said that the balance sheet is from the start of the company to the end, the final day of the company. This is accumulative wealth. It's not year by year. It's published every year, yes, but it's the total accumulated wealth of the corporate. All right. And what keeps the balance sheet balanced? It's the double entry approach, recording financial transactions in minimum 2 accounts. So if you put something in assets, you have to register it in equity and vice versa. That's why it's balanced all the time. Any transaction should be recorded in minimum 2 accounts. Those accounts are really divided into 5 categories: assets, liabilities, equity, and you have revenues and expenses. The assets, liability, and equity capital form the balance sheet, and the revenue and expenses, they form the income statement that we're gonna go through right now in just a few minutes. And then we will close down with the cash flow statement. All right. This is the double entry system. If you bought a car, you pay cash, and then you decrease the cash and you increase the assets, because the car is an asset to you, it's a property. That's why things are getting balanced. I'll not go through debit and credit because you are not accountants. You are not gonna work as accountants, but you should understand how the accountants think. Okay. This is the last screen we were talking about: assets and liabilities. The assets block and the liabilities and equity block. The assets block, it's divided into two smaller blocks, which is current assets and non-current assets, which is also, we call it fixed assets. The current assets is everything that's really current within 1 year. And the non-current assets are the transactions recorded for beyond 1 year. Like if you build a building, if you buy a building, if you buy machines, you buy furniture, and you register them at original cost. This is
Claude, bring the rest of the juice. I want it all.
Excuse me. Hello. If please mute. If you're talking, if you're not talking to me, please mute your mics. If you're talking to me, just you can shoot the question anytime. Please, there is no stupid question. All right, I asked question like hell, and I advise you to ask questions as much as you like. Okay, so the assets block is formed of current assets and non-current assets. And the current assets are cash, prepayments, debtors, and the stock, which is inventory. If I want to be a bit curious, can someone tell me why prepayments is in the current assets? We talked about this last session. I just need someone to tell me, remind me, in fact, what do we mean by prepayment and why it is in the current assets? Can one answer me? No one on the line? Hope you are shy, but not you don't know. Okay, prepayments something you pay for something you're gonna get, like rent. If you prepay it, so it's an asset for you, though it's a payment, but you are getting an asset, which is the right to use the building or the office. Okay, so this is an asset for you. You paid it in advance just to get the benefit of this asset. That's why it's listed in the assets. That's why it's not payment, it's prepayment to get assets. This is what I mean by it. Now, on the liability side, it's divided into 3 blocks. Current liabilities, which are the liabilities that you should pay to customers within 1 year. These are the current. And the non-current, that you should pay to your clients, whoever they are, beyond 1 year, like borrowings from the banks on 5-6 years, like bonds, like loans, like provisions expected to lose some money, or pension at the end of service for your employees. They are non-current liabilities. Why? Because they might not resign now. They will resign after 3 years. So, but you have to hide and put their end of service aside. That's why it's now a must, compulsory by all governments to protect the employees. So anybody resigns, he should make sure that his end of services are really put on aside and they are accounted for. This is the non-current liabilities. The equity shareholder capitals, which is the stocks, the shares, the share capital. How many? If you have 1 million shares and each share is $1, so you have $1 million share capital. You put 10% of this $1 million, which is reserves. You put them on aside. This is also called statutory reserve. It's required by some governments. And you, last thing, you put the retained earnings, things from your earnings, from your operations, from the business cycle. You got earnings, you got some profits, and then you give the stockholders part of this profit, and the others are retained with you. That's why from the income statement, from the operations, profit and loss statements, this figure comes to the balance sheet. That's why they are interconnected. Okay, we call them retained earnings. Retained earnings, that means I retain them for future projects. Okay, we discussed all of those in the last session. Are there any questions before I proceed? Any questions before I proceed?
All okay.
All okay? I will proceed then. All right. Now, this is this slide about what I talked really, assets, what are they? Current assets. And then this is the fixed assets, which is the non-current assets. And you do have, when the fixed assets, some depreciation, because anything you buy does not hold last with you for the the end of life. No, it has a life. So if you buy a computer, it's 4 years life or 3. If you have a car, it's 4 years life. If you have a building, it's 50 years. Those are really notions among accountants. And the furniture goes to 10 to 15 years. That's why. And every year they depreciate by 25%. Okay. We call this accumulated depreciation. If you go to this block here, non-current assets or fixed assets, land, building, machine, furniture, you list them at original cost, you deduct from them, subtract the accumulated depreciation, 25% of all the figure. So you are using 25% of any asset to make some profit with it. This is what I mean. Please grab this message. You are using 25% the first year from your asset to generate some profit. That's why you are using the computer to generate some profit, to work. You are using the furniture to make some profit. It's been agreed that the furniture, it's if it's divided, if the shelf life is the life of furniture is 15 years, so you divide them on 15, okay, and you take percentage every year until the end of this the end life, shelf life of this asset. Okay, one main point: the land does not depreciate. This is a notion among every one of us. Land does not depreciate. You put it in, you register it at original cost and it stays there. You don't depreciate it. Why? Because fact of life, land does not depreciate. If you buy a piece of land right now, it will appreciate after several years. No, it does not depreciate. But if you buy a computer right now, if you buy a phone right now, it will depreciate because after 2-3 years, it will be useless. Okay. This is the idea of accumulated depreciation. Now, the 25% that we make, if you buy a computer and you deduct 25%, where do you list them? Okay, you subtract it, in fact, from the non-current asset, yeah. But where you add it, I will tell you where you add it right now. Okay. Now we came across the liabilities, current liabilities and non-current liabilities, which is something that you have to pay owed by the firm for the term maturing beyond 1 year. If you got a loan from the bank, $1 million, and you promise to pay within 5 years. So every year you pay your debt, but this is on 5 years. However, if you buy some raw materials to manufacture and sell now, it's not non-current, it's current liabilities. Why? Because it's within 1 year. You buy the raw materials, you manufacture the phone and you sell the phone, and you promise the suppliers that you're gonna pay them. We call them creditors. So this is the current liabilities. Anything that you have to pay within 1 year, we call it current. Anything that you have to pay within beyond 1 year, we call it non-current. All right. The equity capital. The equity capital block, it has several titles. Share capital. If you have, suppose you have 1 million share and each share is $1. You have, that means you have share capital of $1 million. Okay, and what if here, because I put an arrow on something called additional paid-in capital. What do I mean by this? This is very important to know because you're going to face it in reading the financial statements. Suppose, let us take Facebook. Who knows what is the share price of Facebook right now? What is the share price of Facebook or Tesla or Google or Microsoft? What's the share price right now in the stock exchange? Anybody knows?
No idea.
Okay. Well, for Facebook, it's around, it started with 21, it became 31 and jumped to 32, and then I think it went down. I'm not following, but within this range. Okay. So suppose we have Zuckerberg, who's the Facebook founder. Suppose he has 1 million shares and each share is priced at 30. So how much is the share capital? $30 for 1 million shares.
30 million?
30 million. That's right. But in books, we do not put the market price of the share. In the book, we put the share as either $1 or $0.50 or $2 max. If you go to Apple, Apple is 50 cents, $0.50. All right. Why? This is the book value. Nothing, it's just a figure. It's a book value. All right. That's why the market price is totally different. Now, in the book value, in books, we put, well, the board of directors of the company, they will say, well, the our book value, our share book value is 50 cents. Then $1 million, it means $500,000 as a share capital. But the difference between the share capital, which is the book value, and the market price, we put it in additional paid in capital. I'll give you an example. I'm not expecting you to understand it very well. I'll give you an example, just you will really absorb it in your brains. Take Facebook. Now it's 30. If you buy 100 shares for a price of 30, that means you paid $3,000. Okay? Now, how they list it in their accounting statement, you got 100 shares. Are you with me, guys? At least someone to ask. Okay.
Yes, yes.
You got 100 shares. In the book value, it's 50 fils, 50 cents. That means they will put it as $50 share capital. But you already paid $3,000 the market price, right?
So your potential base 2,950.
Yes. The additional paid in capital 2,950. Is this clear?
Again, please. Sorry.
Okay. If you buy, let us take Facebook. If you buy 100 shares and each share is 50 cents. So in the book, you paid $50. Correct?
Yes.
All right. But you bought it in the market, which is 30 per share. That means you paid 3,000. So in the book, we put share capital, we call it at par. Par, it means what is set, the price set for this share before going to the market. You put 50 and then the additional paid in capital, which is above 50, what you paid above 50 in the market, it is additional paid in capital. Is this clear?
Yeah.
Yes. And then you have statutory reserves. We talked about them. You have some other companies. They put, yeah, please shoot. Anybody has a question?
A book share. The first time when they put the share in the market, the first price, it will remain the book. Then it will be up and down based on the market.
No,
right?
no deal. Because Facebook, he founded the company and he lived without the market, he lived in the book value, but he did not go public. Okay, and when he went public, immediately they priced his share as 30. However, in the books, they do not put 30 as share price. Why? Because the market goes up and down. So they put the minimum. The minimum is either $1 or 50 cents. So they put the book value for the share as $1 or 50 cents. Go to Apple financial statement. You will read, in fact, the share capital, several millions shares at 0.50, 50 cents each one.
Who decide?
The board of directors. The board of directors decide. This is the book value. Our book value is either $1 or 50 cents. However, in the market, the difference between this the book value and the market, they put it in the additional paid in capital. Okay. And the board of directors get the advice from where? From the bank who really evaluate your company. We call it investment bank. We talked about investment banks last time. If you want to go public, You cannot go public on your own. What you have to do is you contact an investment bank. He will study your case, he'll study your company, and he will tell you, well, in the market, your share price is 30 or 50 or 100, but in the book value, we'll put it $1. So what you care for is the market value. Okay.
Doctor, this is a standard for all public share.
Yes, all standard to everyone, to all companies, publicly listed companies. You will see that share capital is a number of shares at either $1 or 50 cents or $1.50. But the market price is totally different. That's why if you want to buy a company, you don't only read the annual report. You will read and you will think and you will analyze how much it's in the market. What is that? You know how much Tesla's share price? How much is it?
$280. 280 almost.
280. But in the books, it's 50 cents or $1. That's why the market goes up and down. So you cannot move your statements in your annual report as per the market up and down every day. So that's why you put share capital as the minimum amount, which is $1 or 50 cents, and anything at the end of this year, at December 31st, they will check what is the market value, and they'll put additional paid in capital. And the additional paid in capital only for the people who buy shares when you go public. That's why if you want to buy shares, buy earliest. The earlier, the better. Okay? Before it goes to the market and then goes up. Now, the last thing is the retained earnings, which is coming from the profit. It's a figure that coming from the profit and loss that we're gonna discuss right now. Any questions so far?
No.
All right. I need at least one to say no. Now, this is a sample of financial statements. That's why I put land building. I put machinery equipments, less depreciation, which is accumulated depreciation, and the fixed assets now it's 1,500. You got the current assets now, which is stock, debtors, and cash, and the total assets is that much. So you the current assets plus the fixed assets, they form the total assets. And on the liability side, you have bank overdraft creditors, which is current liabilities, long-term debts, which is non-current liabilities, and total liabilities is that much. And share capital, 2 million shares at 0.05, 5 cents only per share, that much. Statutory reserve and retained profit. So the main important thing to know that the total assets are equal to the total liabilities and equities, which is the magic formula applies. Okay, any balance sheet, it should be balanced with those total figures. Assets should be equal to liabilities and equity. Now, this is a sample of a Awal company that we're gonna really discuss, go through it later. And this is the continuation of this balance sheet of Awal company. Notice that the total assets here, 3,597, and the total liabilities and stockholders' equity is 3,597. So the balance sheet is balanced. Look at this. Okay, preferred stock, and you have common stock. Common stock, what you are reading here, 2.50 par. Par, it means the figure that's really decided by the board of directors, the book value of this common stock. So 100,000 shares means multiplied by 250. Okay, this is the common stock value. However, if you continue reading, you have 100,000 shares authorized. So the investment bank, when you want to go to as a public company, the investment bank, he will ask you how many shares you will put, you will aim to sell. You tell him, well, I will sell 100,000. Okay, so they will put that this company is 100,000 shares. We call them authorized to be sold. However, you were not able to sell them all. Why? Because there is no demand on your stocks. What this guy sold 76262 in 2015, and in 2014 he sold 76244. Okay, so the difference 76244 on 2014, he added a little bit, he sold a little bit of shares to reach 76262, 76,000. So what is the difference between those? The 100,000 shares minus the ones sold are still not sold yet. So the 100,000 are called authorized, and the 76262, which is the sold ones, they call it outstanding. Is this clear?
Yes.
Yes. Additional paid in capital, here paid in capital in excess of par. You see, here you put the book value, and here you put the amount that you sold on the market price. Okay, because you cannot go with the market all the time. You put it additional paid in capital because your fair price is high. And retained earnings, total stockholders equity is that much, and blah 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 blah. Okay, we are still on balance sheet. Accrued liabilities, that liabilities beyond 1 year, and common stock, preferred stock. What is a preferred stock? Well, there are two types of stocks. In fact, more than two types. Why? The companies normally they put class A stock, class B stock, class A for the managers, class B for employees, class C for the public. Okay, but all of them are the same. All of them are the same. They have a share price and you pay for them. However, they differ in regulatory issues. For example, well, the employee has more priority than the public because he is a founder. Okay, the senior manager has more priority than the public in decision making. This is what I mean. However, but what I want to say about the preferred stock is companies, they came up with this preferred stock if they want to take debts, a loan from the bank, but they don't want to list this as debt in the balance sheet, in the financial statement. What do? They say, well, we are issuing preferred stock. So I buy preferred stock, but they take the money and they pay me back every year. It's treated as debt. It's exactly like a loan, like a debt, because at any time I can tell them, please sell it to me and give it to me back. All right. In the public, if I bought from the public, if I want to sell them, I go to securities exchange market and I sell them to someone else. But the preferred stock, I send them to the bank. That's why it looks like a loan. It's treated like a loan. This is the difference between preferred stock and common stock. Is this clear?
Yes.
Yes. Now we come to the income statement. We finished the balance sheet, which is the statement of financial position, and then we came to the income statement. Income statement is straightforward, very easy. We call it bottom line. If the manager says, what is the bottom line? That means he's asking what is the earnings, what you have got, what profit you have made. Okay. Anything Anybody tells you what's the bottom line, that means give me the last figure. Give me the end. What's the profit? Okay, what's in it for me? This is what we call it bottom line. It's the income statement is just revenues minus the expenses. Let us see. Are you seeing this screen now? Ahmed Barber Shop, income statement. It's I don't mean Ahmed Yunus, someone else. It's maybe a coincidence of the name. This guy, he made sales. He cut hair. Okay, he's a hairdresser. He made sales $15,000. And then what is his expenses? So the revenues to him is the 15,000. He cut hair of many people, and the fees collected from hair cutting is 15,000. Now his expenses are what? Rent, he pays 5,000. Kids schooling, he paid 2,000. Water and electricity for his shop, 500. He paid for his helper 700. The total expenses is 8,200. And the net income is what he made sales subtracted from the expenses, 6,800. Is it difficult? The income statement is very straightforward and very easy to grab. Revenues minus expenses. Okay, and the expenses that are known. Let us check an example. In any statement, you will read in the income statement only those 5-6 lines, and they come just down each other, one column. You read sales, or you can read the revenues, or you read the turnover. It depends on the country you are residing, because sales in Europe, revenues in States, and turnover in Australia. Those sales, if you are, suppose you are selling phones, for example, you made sales of that figure. What is the cost of those phones that all of them that you sold? Cost, it means the raw materials and the manufacturing and all the power and electricity and all that stuff. So each one, you already, if you want, if you are a restaurant and you are selling sandwiches, you sell the sandwich for 10 dirhams or $10, but you as the business owner, you know that it costs you 7 or 6 or 5. All right, so this is it. You made sales of 100,000, it means 50% its cost, then less the cost of sales. Okay, the gross profit is equal to sales less the cost of goods sold. Either cost of sales or cost of goods sold is exactly the same thing. Sales, revenue, turnover, exactly the same thing. Those three terms. Okay, any statement you read and you read those, you should know what you are reading. So the gross profit is the sales subtracts less the cost of goods sold. You got the gross profit, but this is gross profit. It's not a profit yet. Why? You have admin costs, you have salaries, and you have depreciation. You bought a computer or a cash register that you have to depreciate it every year. And you have to administration costs like electricity, power, fuel, overtime for employees, salaries. You bought pencils, papers, and invoices. You do anything, all those are costs. So from the gross profit, again, less the admin cost, you will get operating profit. Okay, now it's your profit. Now you have operating profit. We call this operating profit, that means profit from your operations during the year. We call it earnings before interest and tax. We call it EBIT. Those terms you should know, because if you talk to accountants and finance guys, they will mention the EBIT. The word EBIT, it means earnings before interest and tax. And it's exactly the same thing as operating profit. Okay. Is it clear so far?
Clear.
Clear. Thank you. Now you did not pay, though you have got your operating profit, you did not pay your interest on the loans that you have got from the bank. Here you put the interest that you put to the bank. Why? Because the interest you are paying it every year. This is an expense. It's an operational expense. And we put it alone on its own just to know how much interest you are paying. If I read an income statement or profit and loss statement, I should know how much interest they are paying. That means I will know how much debts they are getting. All right. Now, you paid the interest, and then we should not forget about the government. The government in the United States, they shoot you, bombard you with 35%. In Europe, it goes to 40%. In UAE lately, it is 9%. I believe so. Okay, if my memory still
Yeah,
valids.
it's exactly 9.
Exactly. Yes. So
Starting from
introduced
June, yeah.
from June, exactly last month.
Yes.
We put it here. Tax for the government 9%. 9% out of the operating profit after you pay the interest, because they don't take tax on the interest. You pay the interest first, and then the government comes in, pops in, give us our percentage. Once you pay the government the tax, now you can say, well, my net profit is that much. This is my bottom line. Okay. We call it net profit, or we call it net income, or we call it earnings. The three are the same: net profit, earnings, net income. All right. So to make it easy to you, I start with sales. I subtract the cost of those sales, and I got gross profit. Now, this gross profit, it's not yet the admin. I have salaries, I have depreciation, I have admin costs. I subtract those, I got operating profit, or EBIT, earnings before interest and tax. Then I pay my interest. Then I pay my tax. Then I'm fully reach the bottom line, which is my net profit is that much, often called the bottom line. Now, this bottom line, you have to distribute dividends to shareholders. If you have $1 million earnings, well, you decide to give the shareholders 40% of them. That means $400,000. You less dividend, and what you have, the last figure, which will be retained earnings. What you do with the 600 left, you don't throw them, you don't give them to charity. You put them in the balance sheet for future income, for future accumulated wealth, for future projects. Re-inject in the capital, so the capital will really bulge. And if it bulges, that means there is growth, there is good performance. You are having returned profits, you are having big money, you are performing very well. All right. Is this clear?
Yes.
Doctor, you said in the previous lecture that net profit net mean cash.
You are 100% correct. I like that. Yes.
Yeah, how we will distribute dividends on the shareholders? For example, you mentioned 400 as an example.
Yes, yes. That's why before distributing dividends, you perform your cash flow, because many corporates, my dear, I love your question. That means you are following me very well. Many companies, they abide to distribute dividends. They will not get this figure only. They will get what they have cash. Okay. And many of them, by the way, they get debt loan from the bank just to pay the shareholders as dividends. Why? If they did not pay them dividends, what will happen? If they did not pay dividends, what the shareholders will do? Will sell their shares. All right. They pay from the cash side of the income statement. Have you got it? From the
Yes,
cash
thank you.
part. Yes, they'll pay from the cash part. And if they don't have enough, they will get a loan from the bank to pay. Because if they did not pay, believe me, shareholders will start selling their shares. The share price will go down, and then they will really lose. So to protect their reputation, they will check their cash. Well, we will distribute that much to shareholders. They will distribute it from the cash part. Although it's not profit, the profit is not cash, yes, but it has cash inside. Okay? Clear?
Yes, thank you.
Yes, because the sales, they are not all of them credit. No, you put part of them is cash, and part of them you got it on credit on credit cards. You will get them after 2 months. So within 1 year, you do have a lot of cash. All right. It has inside within this figure some non-cash, right? We will come to this, but from the cash part, we will distribute dividend. The dividends is very sensitive issue to corporates and shareholders as well. All right.
Clear.
Clear. This is an example. Revenues 20 million, less cost of goods sold 30 million. My gross profit is 7 million. Admin cost and advertising, marketing 1 million. Salaries 2.5 million. Depreciation of fixed assets for the year, not the accumulated. For that year, I used the depreciation to make money, 0.5 million. The total expenses is 4 million. So the operating income, which is the profit, which is the EBIT, is 3 million. Financing cost, the word financing cost, that means the interest on the borrowed money, 0.5 million. Taxes, I pay 35%. And then my earning is 1.6. I decided to give 6.625. Notice, my dear, I did not pay all of them as all the earning. Why? Because many of them, they are not cash. I put from the cash part 6.25 million dividends, and the retained are 1 million. They go to the balance sheet. Is it clear?
Clear.
Clear. Thank you. Now this is Awal company. If you see the slide, sales revenue, less cost of goods sold, gross profit, operating expenses, selling, general administration cost, less expense, any expense you pay, depreciation expenses, total operating expenses that much, operating profit is the subtraction, less interest, and then net profit before tax, and then less tax, which is 29%, net profit after taxes, preferred stock dividends. They pay the preferred stock because it's always it's a stock that is treated as that, and the earning available to common stockholders that much. Earnings per share, we will come to those later on. Okay, this is the income statement of our company. So all those titles, you are familiar with them. You know what they are made up of and how they are treated. Now, this is, in fact, is an exercise. He will give you some figures and he will tell you, please put them either balance sheet or income statement. Let us start with this one. Inventory, where do we put it? Income statement or balance sheet?
Balance sheet.
Balance.
Balance sheet.
Balance sheet. Well, very good. The general and administration expenses, where do we put them?
Income statement.
Income statement, common stock.
Balance sheet.
Yes. Okay. I have a tricky question. You have depreciation expense. Where do you put it?
Income.
Income.
Income statement. Where do you put the accumulated depreciation?
Balance.
Balance sheet.
Okay, so you don't need me anymore, guys.
Okay.
Okay, this is the income statement. Sales, plus goods sold, general depreciation expense, operating expense, operating income, interest expense. And I'll give you a trick. Anything that's really within 1 year related to administrative issue, to operations issue, that means income statement. Sales is an operations issue. It goes 1 year. Admin costs, it's for 1 year. Depreciation for that year. Operating expenses for the year. Anything for the year is an income statement. Anything accumulated beyond 1 year, that means it goes to balance sheet. Okay. Now, is this profit cash? The net income is 3,360. Is it cash?
Not all of them, maybe
Not
cash.
all, exactly. It's not cash because the net sales, it has credit sales as well. And you may not have, and even you look, you put depreciation expense and you did not pay it. You used the equipment, but you did not pay. All right. You have the bottom line, it's not cash only. It has cash, mixed cash and the credit, and it's not only cash, but it is
But this-
profit. Yeah, tell me.
This one depreciation expense deducted. That mean I have the cash and I have also if I did not spend.
Yeah, you did, but you used the depreciation. You used the depreciation of the equipment. Suppose you bought a computer, okay? You put them in the balance sheet. I bought a computer for $1,000. Next year, you used the computer for 1 year. How much it is depreciated?
25%.
25%. But this 25%, you used it to operate, to make profit. Right?
Yes, but I deducted already. Then 3.360, it's already cash in my hand. For the next
No,
year, if I will use the same computer, I will not have depreciation expense more.
no, look, my dear, the 3,600, they are not cash. Why? Because the sales you are selling, they are not cash. You are not selling cash basis. You are selling on credit. Suppose you are selling a car.
You might have a customer didn't pay. It's a bad debt.
Exactly. Suppose you are buying a car. You are selling a car, selling cars. Al Masoud, for example, doesn't he? Don't you?
Yeah, I got your point. I got your point. The things which goes for like loan or for 1 year and more divided. So all of
Exactly.
them with me, but I have in my sheet 3.360, but not all of them in my hand.
Yes, not all of you, not of them in your hand, because the depreciation expense that you use that computer to help you in making that money. This is it. All right. Now, since it's not cash, that's why firms prepare cash flow statements. Here, the financing guys come in, they step in. Profit to them means nothing. How much cash I have. That's why always the CEO will ask the finance guy, the finance manager, can we go for this project? That means, do we have the money, the cash to go for that project? It doesn't mean that do we have profit. He is profitable, yes, but he might not have the cash. That's why the president of the country will always ask the Ministry of Finance, do we have the cash to go for this decision? Cash flow, banknotes. Now we will go into the cash flow. We understood the balance sheet. We understood the income statement. Now we will go to cash flow. This is another example.
I have a question before we move.
Yep.
You
Shoot.
allow me. I have an access in my company. I'm working in an international company, and I have an access for the income statement and the budget and everything. My question regarding the EBIT, because in my company we call the EBIT as the bottom line.
The EBIT,
Yeah,
a bottom. You call it the bottom line.
yeah,
Do you have that?
yes.
So it's not the bottom line. You have to pay interest.
So it's not as per the company. It's a standard, right?
Yes, yes. You have to pay interest, and then you have to pay tax. Since you are in UAE, you don't pay tax, so they are calling it the bottom line. If you don't have a tax and interest, then you can call it a bottom line.
Okay, clear.
All right.
Yeah, clear.
But anything EBIT, it comes later, interest, tax, and then the net income. Clear?
Clear. Yeah.
In UAE only the tax introduced last month, so that's why they might have called it the.
I mean, Saudi we have 15%.
Oh, this is a new, right?
Well, it's like 4
3 years. 3 years back.
3 years back. All right, good.
15%.
Thank you for this info. So that's why we prepare cash flow. This is balance sheet, and this is the three main statements. You see, cash flow statement is cash receipt minus cash payments. We will come to this later, just in few seconds. Here is the balance sheet and the retained earnings, the sales minus the cost of goods, and the income state. From the income statement, it comes the retained earnings. Here they are connected together. The cash receipts and the cash payments, they affect the cash and overdraft, the cash money. Cash flow statement development. First statement done, second statement done, and this is the last one, which is easy, by the way. The cash flow, anything you pay, anything you receive. Payment and receipts. Anything with cash, you can calculate it easily by following those steps. Any company's cash flow falls into three categories. They will calculate the operating cash flow from operations, means from selling and business cycle. What do we have cash flow from investments? We put some money in other companies in the bank for fixed deposits. This is investment. Or financing, we got some debts or we sold shares, we got cash from them. Anything related to cash, it's listed in this statement. Here we know how much cash we have. Nothing, balance sheet and income statement, they are on paper. They are profit. Okay, we will deduct from them, we will deduce from them the cash, how much we paid. From the annual report, mainly, everything is written. How we will do this? Operating cash flows, it's cash flow directly related to sales and production. Known. Business cycle, which is the net income. Operating flows, which is the net income. We will start from the net income. From the net income, we will try to get out the cash from it. We will see how. From investments, well, we purchase some securities in another company, or we purchase some shares in Apple, and every year we have dividends. This is in form of cash. This is cash coming to us. All right. Or financing. We can, from financing, we can either sell a land sell a building, sell an equipment, this is cash coming to us. Or we can get a loan from the bank, this is cash coming to us. We pay dividends, this is cash coming out from us. So anything related to cash is listed here. Here, that is the way to calculate how much cash we have. Let us see. Again, is profit cash? No. Profit, it's not cash, because the profit is the formula for profit, sales minus cost of sales. This is profit, which is gross profit. And the cash is cash receipt minus cash payments. How much cash I got, how much cash payment I pay. Is this clear?
Crystal clear.
Crystal clear. I like that. This is additional slide to tell you what are the cash sources and uses. The cash is equal to sources minus uses. If the sources of fund, cash sales, not credit sales, not all sales, cash sales. And what I collect from debtors, from accounts receivables, what I cash sale from fixed asset, I sell a car or sell a building or I sell something. What I borrowed from the bank funds, this is cash. What I got cash from my financial investment, this is cash coming to me. Bank notes. Now, what are the payments, the uses of those payments? What I paid the suppliers in cash, what I paid cash payment for stock, inventory, I mean. What are the cash payment I paid for fixed assets? I bought a car, I paid in cash. Interest payment, I returned some debts in cash. I paid taxes in cash. I pay dividends in cash. Okay, those are the sources and those are the uses. If you can calculate, this is the sources and this is the uses, subtract from each other, you got the cash left, which is, we call it cash flow statement. And it has a certain form that we're gonna see right now. Do you have a question so far?
No.
Good. So you have the inflows and outflows of cash. And here, many participants, many students, they really get confused. I made it easy to you to understand. Let us read the last line. For non-cash assets, suppose accounts receivables. Do you know what are the accounts receivables? Things you pay to be paid within 1 year.
Yeah.
By credit card. If the previous year value was $1,000 and this year value is $800, what does that mean? I repeat the question. Last year value of accounts receivable in the balance sheet, last year value is $1,000. And this year value, because I have to list 2 years. Last year was 1,000 and this year is 800. That means it got less. That means I got paid 200, right?
Yes.
That's an inflow of cash. Let us check the accrued liability, the accounts payable. The previous year is 1,000. This year is 1,200. That means you did not pay. That means you got the cash. You did not pay. So it's an inflow of cash. Okay?
No, I didn't get it.
All right. Did you get the accounts receivable one?
Yeah, the first one, yeah.
Yes. The liabilities. If your liability was 1,000 previous year, and this year your liability is 1,200, that means you kept the 200 with you.
Yes.
You did not pay.
Yeah.
So it's an inflow of money. Agreed?
Yeah. Yeah.
Yeah,
Yeah, I have a question. Excuse me.
please shoot.
So if we have inflow in both ways, so what's the difference here?
Ah,
Inflow
If-
we have in
okay.
both.
Okay. If you have, if previous year, I made it inflow just to understand the concept, but tell me, let's go to accounts receivable. If the previous year is $1,000 and this year is 1,200, that means 200 outflow. It's an increase in the assets. If the assets is increased, that means it's an outflow. The non-cash asset. I made example on the inflow. If you made it an increase in the accounts receivable, it will be outflow. And if you made it decrease, let us take accounts payable. You have to pay, last year you have to pay 1,000. And this year you have to pay 800. That means you paid 200, right?
Yes.
That is outflow.
Yeah. Okay. Clear.
Got it? Clear.
Yes.
Any questions, guys? I need someone to
Oh, no, clear. Yeah, I got the conflict because I didn't see AR account receivable and the other one was account payable. Yeah.
yes.
Both
All
were
right.
both are for inflow. Yeah.
Yes, exactly. So in this case, this is an inflow. If you are talking about outflow, just reverse the figures, the previous year and next
Yeah.
year, this year.
Yes.
All right. I just gave an example just to make things clear to you, nothing else. All right. Okay. Let us start with the statement of cash flows. This is the general format. We will start from the EBIT, the net income. The net income. You know the net income, which is not the EBIT, the one after you pay, after paying tax and interest.
Bottom line.
Bottom line. Yes. We'll start with the bottom line. How much is the bottom line? We'll put the figure. Now, if you go back to income statement, you will notice that we less the depreciation cost, right? We subtracted the depreciation cost from it, right?
Yes.
Yes, that means we did not pay it. It's not in the form of cash.
100%.
We add it here. So
Okay.
our real net income is really added. Okay.
Okay.
What is the change in our inventory? We go to balance sheet. Is it decreased or increased? As per this formula. Is it decreased? That means it's an inflow. The difference is an inflow. If it's increased, that means it's an outflow. All right. And this is all those. Let us go to the real life examples. You printed the 4 slides. Did you? Did you print the 4 slides that I asked you to do?
Yes.
All right. Let's go to this example. Tell me what is the net profit after tax from your income statement? This is sample. Okay. Yeah, tell me.
From which side? From this example? Okay, so the net profit is 231. This is
Exactly.
after taxes. Yeah,
Okay. Add the depreciation. What is the depreciation?
239.
Yes. So okay, from the balance sheet, what is the accounts receivable difference? How much was it and how much is it in previous years? From the balance sheet, because I asked you to print 4 slides.
Yeah.
Balance sheet, income statement, and this inflow outflow. From the accounts receivables in the balance sheet you have, how much is the difference? Are you reading the 4 sheets, guys?
327.
Minus,
No, I think it was 3,597 minus 3,270.
so what is it?
The difference is
7.
327.
327. Yeah, the diff.
Okay, is it did it increase or did it decrease?
Yeah, it's increased in 2000.
It's increased, then it should be deducted. You did not pay it. You did not get it. So it's an outflow.
Why it's not inflow?
Yeah. Let's go back to this slide. The accounts receivables. If the previous year is what? What is the previous year? Tell me in your sheet. The previous year.
3,270.
Okay, and this year, the one after the
35.
previous.
3597.
So it's
227.
so it's increased.
It's showing increased.
Increased. That means it's an outflow.
Outflow, yeah.
Exactly. So
Yes.
look at this outflows increase in the assets. That
Yeah.
means you did not get it. You are still selling in credit cards. You did not get cash. That's why you decrease it. It's an outflow. Go to this one. There is an increase in accounts receivables. He deducted it. And there is a decrease in inventory. He added it. Increase in accounts payable. He added it. Increase in accruals. He added it. So the cash from operations is $500.
No, I'm confused.
We will get back. All right, here. For non-cash assets, accounts receivables. The previous year is 1,000. This year is what?
800.
800.
Okay. What does that mean? That the accounts receivable you got paid. It's not anymore 1,000. It became 800. So you were expecting to receive 1,000 previous year, and then you're expecting to receive 800. That means you already got paid 200. Yes or no?
Yes, clear. This one clear. I think we got conflict in the example itself because we
Yeah. It's not the same figures, right?
yeah.
It's not the same figures.
I
But
think,
the concept is there.
I think also we provided the numbers for the total liability and the stakeholder equity, and we didn't read the first page that contains the account receivable and inventory.
Please read it. Read the accounts. What is the accounts receivables?
Account receivable was 365 and increased to 503.
So what is the difference?
The dev is 503 minus 365. So the dev is 138. Yeah.
It's there.
Yeah.
Okay. Decrease in inventory. The next figure. Is the inventory decreased?
Yeah.
Yes, by
decreasing
11.
by 11. Yes.
Decrease it means you sold it. The accounts payable, is it an increase?
Account payable, it increased. Yes.
By 112.
Yeah.
Exactly. So that means if the accounts payable increase, that means you got the cash, but you did not pay them. Right? You got from your suppliers, but you did not pay your suppliers. So you have the cash you did not pay. This is an inflow to you. Hello,
Yeah,
guys.
yes.
Yeah, we are with you, but it's tough for us because not all of us are involved in the financing modules. a lot.
Yeah, but I'm just telling you how to get the cash flow statement.
Yeah.
Decrease in inventory, the increase in accounts payable, blah, 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 blah. And then you get the figure of cash provided, the cash provided from operations. Now, the rest are easier, by the way. Cash flow from
We
investments.
consider the 227, it's inflow.
Yes, the what?
The 227, the difference from the net is inflow.
Where you get the 227 from?
Total liability and stockholder equity.
No.
Not all of them are cash.
Not all of them are cash. You go to accounts receivable, you go to inventories, you go to accounts payable, you go to accruals, each figure by each figure. Figure by figure, you have to read.
Yeah, to take the figure one. What the difference between 214 to 15 figure by figure? I don't think.
Okay. So your operations that includes accounts receivable, accounts payable, and your stock and your accruals that you have to pay and your depreciation for the year, you got the cash as $500. Now let us calculate the cash from the investment activities. Okay, you make an investment of what? You bought fixed assets. So there is an increase in fixed assets. How much was the fixed assets previous year and how much is it in your sheet? The difference.
It was 2266 and it increased 2,374.
Exactly. So the increase is the outflow that you paid is 347. 347.
I don't think so.
The fixed asset, go to the fixed assets.
That was 226 minus 2374. Should be 108.
Yes, 108 increase.
Yeah. The net
In-
fixed assets, it was in 2014 2266 and it increased to 2,374.
Okay, let me go to Awal. Here is Awal. Okay.
Okay. Yeah.
Which figure you are reading?
Oh,
This is the gross fixed
yeah,
assets.
yeah. I read the net fixed asset.
4669 minus 4322. How much is it?
Yeah, I read it from the net fixed assets.
No, we are not going to net fixed assets. No, this is accumulated. This is less accumulated depreciation. The
Yeah.
gross fixed assets.
Yeah, 347, right?
Exactly. 347. All right.
Okay.
All right, good. We are not moving before you understand those things. Now, there is no change in equity. It means the same shareholders, and the cash provided from investment is outflow of 347 because you paid for the fixed assets. Now, the cash flow from financing activities, notes payable. It is a decrease. That means it's outflow. You paid them. The difference is 20.
Yeah.
The increase in long-term debts is 56. That means you got more debts, 56.
Yeah.
And there is a change in the stockholders' equity of 11,000, which is 11. And then you paid dividends as 108. This is from income statement, the dividend. Go to the income statement, check the dividends. How much dividend you paid? How much dividend you paid in the income statement? Are you guys with me?
Yes, we are looking.
Income statement, the last line, or the one before last line, because dividends paid the end, before retained earnings.
0.75 and 1.29.
Okay, what is the difference?
Different 54.
No, it should be 108. Let me check again. Income statement.
Income statement dividend per share 0.75 and 1.29.
Dividend, this is per share. No. How much you paid dividends? Profit done in earning to one. This is dividend per share. This is different. So the figure will be given to you that we paid it as 108. Then we will come to the dividend per share. Dividend per share is, how much is it? 1.29. How many shares we have?
100,000.
How many shares we
100,000 share we have.
100,000 shares? No.
I think we
In
have
2014, no,
We go to what is the dividend paid? Common stock, sorry. Dividends per share, 1.29. The difference is not listed here, guys. The dividend is not listed here in the annual report. It is 108. That means you paid dividends 108. That's it. And when you get the cash out,
yes,
pay. It's not that complicated, but it's some. All right.
I couldn't hear it.
So sorry.
There was interruption.
Yeah, there was interruption. Okay. Now you are hearing me clearly.
Yes, yes.
Okay. The dividends paid, they are paid in cash. That's why it's not listed in your statement. I will tell you why. It's the difference is 108. So last year was that much and this year was that much. That means we paid 108 dividends. The cash from financing activities, it's the addition of all those figures, and then the net, which is the cash from operations and the cash from investment and the cash from financing, it becomes 292. So though our net income is 231, how much cash we have?
92.
92. Okay, so that's why profit is not cash, because there is increase or decrease in accounts receivable, this inventory, it's affected by accounts payable, it's affected by fixed assets that I paid for, it's affected by the debts that I paid, it's affected by the dividends that I paid. And the net, the cash is 92. That's why the motto is cash is not profit. Okay. Did we understand how to get the cash flow statement? You are not the ones who are gonna work in calculating cash flow, but you should understand what does it mean and how they calculate it. Is it now understandable?
Yes, yes.
Yes, yes. Yeah.
Okay. All right. Now, guys, it's 7:30. Give me 2 minutes to finish this part, and I will come to you. We will meet in 10 minutes time for the other part. Okay. Financial statements, they are industry specific. For example, if you go to Al-Marai, big company in Saudi Arabia, one of the very big companies in Saudi Arabia. I really respect this company. In the assets, you don't see only cash and accounts receivable and stock, and you will see biological assets. Biological assets, that means they have cows. Okay. For construction companies, they have different type of assets. So anything that really assets, it's industry specific. So if you are reading Al-Marai, it's different than reading something else. A company example, they don't put tax. What do they put in the income statement? In the income statement, instead of tax in Saudi Arabia, what do they put?
Zakat.
Zakat. Exactly. It is tax, but they listed zakat. That's why I said different of businesses, different name. It's exactly the same meaning. All right. Now this is a summary of what we have talked, and then we will come to financial ratios. I will meet you in how many minutes, guys?
10 is okay.
10 is okay. Is
Make it
10 minutes
15,
okay?
please. Yeah.
Sorry, say it again, please.
Make it 15, please.
Make it 15.
Yeah. Thank you.
All right, I'll make it 15. So 7:50. Oh, 8:50. Okay. We will meet at 8:50 if God wills. All right. Meet you there. Hello again. Hello. Someone to respond, please.
Hello.
Hello.
Yes, can hear you.
Hi, hi. I hope this session it's a bit tough, but you know how systematically goes. Did you?
Yes.
All right. Because you're not gonna be accountants, you're not gonna be cash flow preparers, but you should know that what they care for is cash and how do they calculate it. And if a company is profitable, doesn't mean it does have cash. It might be, it has a lot of profit, a lot of sales, but they did not collect cash. And here is the problem. If they did not collect cash, that means the company will bankrupt sooner or later. It means bad management. Okay. Now, I think that now it's time to hit the road. This is an easy one. It's called financial ratios. Now, we do have 3 financial statements, and mainly the income statement and the balance sheet. You do have the 2 copies of the balance sheet and the income statement. We will study something now, it's called ratios. I'll give an example to you and please respond. In Lebanon, we have, I'm just giving an example. The population in Lebanon is 4 million. And 3 million people are using mobile phones. However, if you take Egypt, how many people are using mobile phones in Egypt? It's around 60 or 70 million. Does that mean that the users of mobile in Egypt are more than the users of mobile in Lebanon?
Of course.
All right. Of course. Well,
Again, sorry.
I'll say it again. In Lebanon, we have only 3 million users using mobiles. And in Egypt, you have 60 million people using mobiles. Does that mean that in Egypt, you are using more mobile phones than Lebanon?
So 6 million over how much the population in Egypt?
You are correct. So the 3 million out of 4 million is 75%. The 60 million out of 130 million, it's around 40%. That means Lebanon is using more phones. Have you got the figure?
Yeah, you are talking about like
Ratios.
average
Exactly. Percentage.
according to the population.
Yeah, exactly. So to compare 2 different countries or 2 different companies, you go for percentage. We call them ratios. Okay?
Yeah,
Okay.
exactly.
Ratios help us to compare 2 values. What is it in first place? It's a relationship between 2 values. Okay, you divide 2 numbers by each other. This is it. I'll give you another example. Distance from Abu Dhabi to Dubai is 156 kilometers. I drove 56 kilometers. What is the percentage of distance left?
Almost 60.
Say it again.
Almost 60% left.
60% less, almost 60%. How did you come to this figure? You divide the 56 by 156. Okay. So 56 divided by 156, multiply it by 100. It means I drove 35% or 35.8, 35.9%. minus 100%, that means 64% left to me. Okay? Have you got the idea of ratios?
Yes.
Yes, yes.
That to compare two companies with each other, we have to take care of ratios. This is the only way to know how this company is performing and how the other one is performing. Okay, let me give you another example. This year you have got a profit $10 million. Is this good?
Excellent.
This is excellent. Well, in fact, no, because last year we made $20 million.
Depends. We need to compare.
Exactly. You need to compare. Don't say upfront. You need to compare. So that means you lost 10 million. You did not really got profit 10 million. All right. You need always to compare. So once you put two ratios together, you make the first ratio, compare it with the ratio of the previous year. How is it? Okay. Did you do good or bad or worse or same thing? So percentage compare numbers of mobile users between two countries. We said about that. Using financial ratios helps you to know the performance of the company. You compare companies to each other, one in the mobile industry, one in restaurant industry, okay, food industry. So you will know how much profit is making, how much profit. You cannot say, you might find, well, the 10 million for the food is very good and the 10 million for the mobile phones is bad. And you
Based on
should
expenses.
tell me, sorry?
Based on expenses.
Yeah, there's an expenses, right? But I mean, if you get two figures, you have to compare them together. If you want to compare food industry with telecommunication industry, each one has its own domain. However, comparing them, comparing their ratios, you will come to know, well, this is making better than that.
But popularity is important. Yani, even if you said Egypt 40% using mobile, but still you are huge in talking about 60 million mobile. If we are talking about business.
I did not hear you well. Please say it again. I did not hear you well. Please say it again.
I said popularity is important, even when you said like 40% in Egypt, but 40% is 60 million mobile. It's important for finance and marketing and company.
Yeah. If you want to compare two countries together of mobile users, suppose 3 million out of 4 they are using, that means 75%. Right?
Yes, but in compare with the number, if you said Egypt, you're talking about 40%, but still it's 60 million. The customer,
But their population is 130 million.
yeah, but we are talking about profit. That means we need.
No, I'm talking about mobile users.
Yeah, users, more users, that means more profit.
Right? But how much? What is the percentage of users that are using in using mobile? In Lebanon, 75% they are using mobile. In Egypt, they are 60% they are using mobile. So who is more really
or mobile company?
Mobile users.
Mobile user, which one better for me, Lebanon or Egypt?
No, it's not a matter of better. It's mean advanced. Well, they will tell you if they tell you, well, this country has 0% illiteracy, and everybody has education. That means all the population is really educated. This is advanced than in any other country that has 2% illiteracy. The 0% is much better than the 2%. Why? Because all the population there is educated, and here 2% of the population is not educated. So the educated people are much advanced than the other countries. So that's why you compare countries. And same applies with companies. If they're, tell me, look, if a company is making return to shareholders 10%, and another company, they are making returns 12%, which one you invest in?
12% for sure.
Exactly. That's why how you calculate the profit, it's not by the number itself, it's by ratio, by percentage. If a company is getting profit $10 million, and another company getting a profit $20 million, which company you invest in? You don't go to the 20 million because it's more than the 10. No, you go what is the percentage of the profit is for the shareholders. Well, the percentage is here 10% return to profit to shareholders, or 12% to shareholders. You go to the 12%. So you go to ratios. Ratios are very important. It will help you to compare two companies together. Okay. Is this clear?
Yes.
If not clear, we will say it again. Is this clear?
Yes, yes.
Yeah. What we use in ratios, cross-sectional. Cross-sectional, that means I'll put two firms. If I want to take, for example, Amazon, I compare it to who? I compare it to Alibaba. Same domain. To check which one is performing better, because they are two same industry. Now, if you want to compare much better, take more companies. And if you want to compare much better, you take companies and time series. Time series, that means 5 years, because 1 year is not enough. Because in 2020, for example, you have got COVID, everybody went down. Does that mean all the companies, they have to bankrupt? No, it's just 1 year. And then the other years, you compare ratios, last year, previous year, second year, first year, you compare at least 5 years to check if this company is really growing or it's going down. Okay.
Okay.
Time series analysis this is what we're talking about. Time series. By time, every year you analyze to check if it's going down or going up, the growth. Now, again, from our company, table 1 and table 2, the papers that you have got, we have 5 categories of ratios. The first category is called liquidity ratio. Liquidity, that means how much liquid they have, how much cash, what is the performance. We call current ratio equal to total current assets over total current liabilities. Now, the current ratio is a measure. It measures the short-term obligations. Does the company able to meet its obligations? It means their current assets, they should be greater than their current liabilities. Go to the table. What are the total current assets of the company? In the balance sheet, total current assets, how much?
In 2015, 1,223.
Exactly. And the total current liabilities, how much?
$620.
Exactly. If you divide total current assets over total current liabilities, that means it will come 1.97, which is close to 2, correct?
Yes.
Yes, the norm, it should be 2 compared to 1. It should be double. The total current asset should be double the current liabilities. That means the company is doing well and its current assets can meet the obligations of the current liabilities. Is this clear?
Yes, clear.
Here we compare companies, and here not only companies, we analyze the company itself. Is it doing well or not? That's why we are using the financial statements, the balance sheet and the income statement. We divide numbers by each other. We will see how the company is doing. Is it doing well or not doing well? Now, the first ratio, current ratio, we call it current ratio, total current assets over total current liabilities. We divided them, we came to 1.97. Well, very acceptable, close to 2. The norm, I wrote it in yellow. The norm should be 2 to 1. The current assets should be double the current liabilities. If it is not double or close to double, that means the company is not doing well. The liabilities that they have to pay is more than the norm. That means it has a lot of debts. Okay.
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 All right. Should I say it again?
No, it's clear.
It's clear. The other ratio, we call it quick ratio. If you notice in the balance sheet, you have inventory. Okay. The inventory is not, you cannot sell it immediately. That's why it's not fast cash. We call it not near cash. Quick ratio is total current assets minus the inventory divided by total current liabilities. It should come to 1. The norm is 1 to 1. The current assets minus the inventory should be equal to the current liabilities. If it is more, it's much better. Here, the quick ratio is 1.51. That means it has cash more than it has to pay cash. Is this clear?
Yes.
Yes.
Yes, we call this acid test. Now, inventory turnover, that means how many times the inventory is really being sold per year. We divide cost of goods sold from income statement over the number of, over the figure of inventory, the value of inventory in the balance sheet. So the cost of goods sold over the inventory, we get 7.2. That means it's how many times per year the firm inventory is turned over. It's been sold. 7 times it's sold. Yeah, I mean, I buy 100 phones, I sell the 100 phones 7 times. The first 100 I give them, and then I get another 100. I sell them. A third 100 I sell them. So 7 times I turn over the inventory. The more you turn over the inventory, the better. Why? If you are selling very much fast. Okay.
Okay.
Someone to say okay, please.
Oh, okay. Okay.
All right. Now, what is the average of inventory? How many in days? So the turnover is 7.2, so 7.2 times your inventory. But the inventory, each item, how many days it's before it's being sold? 365 days divided by 7.2, you will get 50 days. That means each item being sold, it's being kept in the stock for 50 days only. That means the company is doing well. Other companies, if the same stock is staying 70 days, that means selling as fast as this company. Is this clear?
Yes.
Doctor, is there any limit time for the inventory
They
turnover?
are easy. No, it depends on the industry. Take Al Masoud cars, for example. He cannot sell the same cars 707 times. No, 3 times is good. It depends on the industry, but the mobiles, you have to sell it for, it should not stay in the inventory more than 20 days. Okay. Companies with the same industry, you can know who is doing better. If I am having a mobile shop and each mobile is in my stock for in 20 days, and that guy is keeping the mobile for 30 days, that means I'm selling faster. I am performing better than him. Correct?
Yes.
Correct.
So exactly. So the number of days matter. But if you take the number alone, 50, it means nothing. But compare it to another number. You got the idea? That's why ratios should be compared.
Doctor, we are losing you.
There's interruption.
Sorry, you are losing the sound, the voice, my
Yes.
voice.
Yes, yes.
Okay, is it clear now?
Now, yes.
Yeah, because you have to just excuse me because I'm connecting through microwave connection in the mountains. That's why. Okay, we have to take it easy on each other. Now, the activity ratios, the first three about it was liquidity. Liquidity means assets and liabilities. Now, the activity that means the average collection period, the accounts receivable, how many days you are collecting your accounts receivable. How many days it takes you to collect the accounts receivable. You sold items with the credit card and they will pay you later. If they pay you within 30 to 40 days, this is good because the norm is 30 to 40 days. If more than that, that means you have a problem in collection of your accounts receivables. How to cut this number? Accounts receivable divided by the annual sales, which is the sales from the income statement, divided by 365. You will get for our company 59.7 days. That means it's not doing well. That means though it is really a profitable company selling good, the inventory is turning over and the assets and liabilities are very good, but the management is not doing well. She is not following up to collect their debts from debtors. Is this clear?
Yes.
Same thing, accounts payable. Divide accounts payable by annual purchases. Annual purchases is the cost of goods sold. Because the cost of goods sold, the annual purchases. This is what you purchase. And you sold them. You divide the numbers, you'll get 95 days. The norm is how much? 40 to 50 days. That means you have to pay your suppliers within 40, 50 days. If you are paying them within 95 days, that means you are delaying the payment. That means you are really not doing well or not doing well in cash. that means your management is lousy. Okay.
Okay.
All right, please. Whenever I say okay, I want to make sure that the idea is transmitted, is understood. Now, total asset turnover. How the sales over total assets, it gives you the efficiency, how efficient you are in generating sales from your assets, from all your assets. Sales divided by total assets, you will get 0.85. Now, the norm is the higher the better. More than 1 is good. More than 2 is good. It means the sales are very big, bigger than the total assets. Okay. Normally, the sales are not bigger than the sales, the total assets, but they should be, if you compare two numbers, the higher is the better. Now, debt ratio, how much debt the company has. Divide total liabilities by total assets from the balance sheet. You will get what is the debt they have, how much the assets they have, how much the liabilities they have, and divide by each other. The first one, total asset, current asset over current liability. This one is total liabilities divided by total assets. These are figures are in the balance sheet. All right. If the lower is the better, but why we are talking about debt? That's something they have to pay to lenders. So this company is 45.7 days, acceptable, by the way. Now, this is financial leverages in England. We'll skip it. Times interest earned ratio. Now, if you go to the income statement, the EBIT itself, how many times this EBIT can pay the interest? So divide the EBIT by interest. What you will get? How many times you are able to pay the interests with your earnings? The higher, the better. Well, if a company is able to pay its earning is 4.5 times its interest, and another company, it's 10 times the interest, that means who is doing the 10 times, it's much better. Okay.
Yeah.
Those should be easy. Extremely easy. It's just a formula. Divide two numbers by each other and you will get the result. But each one you should know what it does. This guy, this leverage ratio times interest earned ratio. That means how many times you are able to pay the interest with your earnings. This is it. And you can get, they might ask you times interest ratio. What is your time interest ratio? If I want to give a company, invest in a company, by the way, I always go to this ratio. I'll check the EBIT divided by their interest. I will check how many times they are able to pay their interest. That means they are going to pay me because it's interest. If I give them loan, they give me the interest, the return to me. The higher, the better. Now, common size income statements, we go to percentage. What is the percentage? Look at this example. He has done all the percentage of this example. We will come to those. The gross profit margin. What is the gross profit margin? It's a gross profit divided by sales. That means it's a percentage. In income statement, go to income statement. Do you have the income statement with you? Do you have the income statement with you of the Awal company? You do. Do you have the income statement, guys? The ones that I told you to print. Gentlemen, ladies and gentlemen, please answer me.
Yes.
Yes. What is the gross profit for this company? How much is it in the income statement?
It's 986.
Okay, what is the sales?
Sales revenue at 3,074. Yeah.
Exactly. Divide gross profit 96 divided by 3,074. You get to 32.1%. So the margin, their profit margin, gross profit margin is 32%. Compare it with another company, you will see which gross profit margin is much better. Now the profitability, OPM, which is operating profit margin, operating profit divided by sales. Same thing. The operating profit for this company is 418 and divided by 3,074, it will the operating profit. Sorry, are you seeing my screen? I got disconnected. Are you seeing my screen?
Not yet.
No.
Not yet, boss.
Hello, I'm connected now. Are you seeing my screen?
Not yet.
Not yet. Let me share my screen, please. Are you sharing? Are you seeing my screen now?
Yeah, clear.
All right. This is the operating profit over sales margin. Sorry for this interruption. Now, the net profit margin, the earning available to one. How much is, what is the last figure? 2 to 1,000, right?
Yes.
Yes.
Divided by 3,074, it's 7%. That means your net profit margin is 7%. That's why if you hear something called, what's your profit margin? 7%. Well, you are making profit 7% of in your business. You compare it to the previous year or you compare it to the other company in the same industry. Now, what is the earning per share? The earning per share is the earning you got the bottom line divided by number of share outstanding. What is the earning is 2 to 1,000. And the number of shares outstanding, can you read it in the balance sheet? Number of outstanding shares, it's 76262, which are the shares that are really sold to public. Divided, so the earning per share is 2.90. Normally, the higher, the better. The dividend per share, the dividends paid to stockholders divided by the number of shares outstanding. This is DPS. If you pay dividends, 100 million, and the shares is 1 million. So 100 over 1 million. It means every share, dividend per share, every share got a certain dividend. Now, if you got dividend payout ratio, what is it? You got earnings, net income 10 million. You pay out 4 million. What is the payout ratio? I'm getting disconnected, guys. I'm sorry, I'm getting disconnected. I don't know why, because the weather is not that good. Okay. Now the dividend, if I got, I'll say it again. If I got earnings 10 million, I made payout 4 million. So what is the percentage? Should I say it again? Someone to follow me, to answer me, please. Someone to answer me, please. Hello? Hello?
Can you repeat again the numbers, please?
If I got earnings 10 million, I pay dividends out of this earning 4 million. What is the ratio, payout ratio? How much I paid? 4 million,
40%.
right? 40%, because 44 divided by 10. That means dividend paid divided by the earnings. It's 40%. So if a company is paying 40% as dividend, and there is another company paying 30% as dividend, the 40 is much better. So the higher the better. That means it's more profitable, more cash it has in the company. Okay. Someone to answer me, please. Okay, understood?
Yes.
Those ratios are very easy, but they are the very much important, the most important part, because this is the part that you're gonna analyze the company if it's doing well. You analyze the management, you analyze the dividend paid out, you analyze the finance, you analyze the ability to pay the debts. Now, what is the return on asset? All the time you are reading return on assets. How to get the figure? Earnings available to stockholders, which is the bottom line, earnings, divided by total assets from the balance sheet. You will get 6.1%. So the return on assets is 6%. The higher, the better. Again, same with equity. Earnings over common stock equity. The higher, the better. ROE, we call it. Now, the last one, which is PE ratio, price earnings ratio. That means it measures the amount that investors are willing to pay for each dollar of firm's earning. This is the PE ratio. It's the market price per share of common stock divided by the earning per share that we calculated earlier. This is the EPS, earning per share. The earning per share, if you are getting $2.90, it means close to $3 per share you are getting earning. Okay, not dividend, earning. You are earning around $3 per share. Okay, what is the price over this earning? Divide the market price over this EPS, you will get, well, PE ratio is 11%, which is a good ratio. This is the everything about ratios. Okay, it's straightforward, just formulas. I sent you an Excel sheet. It has all the related and the most important ratios that you're gonna calculate to analyze a company. It's called, this is my recommendation to you. It's in one sheet, all the ratios and all their formulas. Did you receive it? Did you print it? It's been uploaded to you on the shared drive. Are you aware of it?
Yeah, I got it.
You got it. It's just one sheet. It has all the formulas of all the ratios that you're gonna use to analyze all the companies. Okay, and this is the way. Just divide two figures by each other. Now this is the summary of all the analysis per the years, and you will see that the result is okay, good, better, good, poor, blah, blah, blah. You will know how the company is doing well or not. This is also summary. And though ratios are very important, but remember that it has limitation. Why limitation? Because they are just numbers on the books and they are old numbers. Yeah. If you got the number of last year, that means it's a last year number. Maybe this year is doing much better. This is a limitation. Okay. They look backwards. They don't look forward. They don't look ahead. You are analyzing how the firm did, not what will do. Is it understood? So when you are analyzing the company, you're analyzing its past. Ratios, they give you the past. However, as a humans, we don't know the future. If we want to know the future, we will read the past, the history, and we'll see, we will just get a figure about the future of the company. The more years you study, you analyze, the better the future figure you can get. Is this clear to you so far?
Yes.
Yes.
Yes. Let me now go to the other module, last module, please. I will close this one and share the other module. All right. Are you seeing my screen now?
Yes.
Yes.
Module 4. Okay. Module 4, we finished now the financial statement as we finished the analysis of financial statements. It took a long time, by the way. We'll go a little bit here faster because we are talking about plain English, budgeting. Can someone tell me what is budgeting? Anyone?
It's planning for the financial module for the coming year.
Yes, exactly. Planning of the financial activities. That's why it's listed in money. Money is the language of business. It's a planning and control. Why it's used? It's used forward thinking. What you're gonna do, what you are planning to do. You coordinate activities between departments. You set target. Well, I'm gonna sell 6% this year additional. I'm gonna get how many dollars. It will give you a picture of your plan to the future. That's why the management always tells you, give me your budget. The budget is just for, you have 4 types of budgets. Companies, they make either incremental. I think my internet it's not stable right now. Are you hearing me clearly?
Yes.
Okay. Companies, they make it they can make it incremental. Incremental, that means the budget of last year we will add 10% to it. So this is called incremental budget. They don't waste time on this. Just put 10% more and lift the budget. Why? Because this is used by the banks. Because the banks, they go by standards. It's a monotone. Number of depositors to be increased 10 years, 10%, our loans 10%, blah, 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 our activities 10%. And other companies, they might use a priority-based budget. Priority-based, that means it goes by priority. Well, this year, our priority is to build a tower. Okay, let us budget for this tower, for this priority. So other companies, they start every year, they start from scratch. Our company, we were starting from scratch every year, zero-based. We call it zero-based. Every year they call us, they call head of departments, you prepare your budget. Every department prepares his budget zero-based. He plans for the next year what he gonna do in details, blah, 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 put them down, how much he needs money. And activity-based, it's used in construction companies. Why? Well, our activities now to make maintenance to Khalifa Tower and to maintain the tackle the municipality. And well, let's go to the government because they have much more money than us. This is how it goes. So either activity-based or zero-based or priority-based or incremental. The most used is incremental and the zero-based. All companies, either incremental or zero-based. The others are really industry specific. Now, what
Can
are
make two methods together?
No, you cannot make two methods together because they are contradicting. Incremental, that means you get the old figure and you increase on it. But in preparing the budget as a department myself, I look at the previous year, what I missed and what I did not do, I put it in the other year, in the next year. Okay, so I make it zero-based, but depending on the previous year, but I don't add 10% automatically. Okay.
Okay. Yeah, because in my company, and we use the incremental because we used to build our budgeting based on the historical data and last year actual numbers. But also we have capex and investment and something under the priority base. We will focus on something and we will get our growth from it.
Yes, yes, you can do that. You can do that. Yes. Are you in banking industry?
No, I'm in logistic industry. I'm working in Aramex.
Logistics, they do that. Yes, logistics, they follow the incremental and they get some from here and there. But this is not really, we cannot say that this is incremental. No, you are looking at the history and then you are making things that tailor to fit your plan for the next year. All right. Now we have two types of expenditures. We have short-term expenditures and we have long-term expenditures. The long-term expenditures, there is a jargon that we call it CapEx, capital expenditures. That means you are buying some fixed assets, something related, you list it in the balance sheet. CapEx, we call it CapEx, capital expenditure. It's long-term assets, computers, cars, equipments, manufacturing equipments, building offices, blah, 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 blah. Those are assets that are called CapEx. It's beyond than 1 year. They last a lot. Now, the other type of expenditure is operation expenditures, which is OPEX. That's why in companies, they will tell you, is it CapEx or OPEX? What do you want? Which figure, what budget you need? Is it an OPEX or a CapEx? CapEx, it means, are you gonna buy with this money you need capital expenditures, long-term assets, or you're gonna use it for your salaries and electricity and some pens and stationery and all those raw materials? Okay, so two types of expenditures, CapEx and OPEX. Is this clear? Normally, if you notice, the OPEX, which is the operating expenditures, they go for one accounting year. They go into the income statement. And the CapEx, they go in the balance sheet. So that's why there are two types of expenditures. Now, financial planning process. Are you able to make financial planning? Are you able to plan your profit? Let us see if we are able to plan our profit. Financial planning, in every company, who will prepare first his budget? Can one tell me? The very first department to prepare his budget?
Finance.
And what? Who?
Finance.
No, it's not. The money generating, the money generating department. Who generates the money? In any company, who generates the money?
Sales.
Exactly. The sales starts and everybody rest, all the rest, they follow. I cannot start if I'm not sales. The sale can start. Why? Because on in history, his historical, he can tell, well, I'm gonna get some money, I'm gonna get some sales that much. And in order to get this sales, I will tell them I need this much in order to get, for you to get the sales. So we start with sales forecast, and then the production, raw materials, and then the long-term planning, the financing. And then from those, we will get the pro forma. Pro forma means the planned, the forward-thinking income statement. That means the income statement that I expect building on my sales figures that I prepared. Because the sales comes the first figure in the income statement. The sales starts. Is this clear?
Yes.
It is clear. Yes. So you cannot work with those before finalizing the sales forecast, production, and long-term financing. And you plan what fixed assets you want to buy. You plan your current balance sheet. Now, this is pro forma income statement called profit planning, and the cash budget, which is the cash flow, cash planning. Sales forecast starts. I'm giving you an example of budgeting. How do we prepare our budget? We understood now that we start with sales. Okay. I have a company that I'm selling RAM, which is the random access memory in computers. This is my sales budget for Q1 of 2015. How many RAMs I'm gonna sell for Jan, Feb, and March? How many budgeted RAMs I'm gonna sell? I'm expecting to sell in January 10,000 RAMs, in February 15,000 RAMs, and in March 25,000 RAMs. Now, how much each RAM? I'm gonna sell it for the sale price 10. That means my sales for January, I'm expecting it to be $100,000. In Feb, $150,000. And in March, I'm expecting $250,000. This is forward thinking, forward planning. It might not be true. Yes, because nobody knows the future. However, everybody should plan for the future and should increase performance. Are those figures clear?
Yes.
Okay, so I'm expecting sales for January 100,000, for Feb 150, and for March 250. Now, this is not finished. This is the sales department finished. Now the production. In order to sell, I have to buy them, to purchase them, or to manufacture them. For this 10,000 that I'm gonna sell, I need $7 each RAM. I'm buying each RAM for $7. So my cost of production or cost of purchase, $70,000 in January, for $15,000 that they can be sold. Everyone is costing me $7. I'm selling it for 10, but it costs me $7. 105, and in March 175. So I finished the sales and I finished the cost of sales, correct?
Yes.
Okay. Now, but those guys, though I finished the sales, the cost of sales, I need to budget for the administration cost. The administration costs are clear to me. Why? They are fixed. I'm paying rent every year, $20,000. I put 20, 20, 20. Okay. The rent 2020 5,000 in January, 5,000 in March, 5,000 in February. So the total is total selling and admin cost, which is selling and admin cost mean wages and salaries, 60,000 for this quarter, and the rent I am paying 15,000. So the total operating expenses, how much?
75,000.
75. Good. Now, automatically the income statement has come because I'm expecting for quarter one to sell 50,000 rams. Look at those. 25 plus 15 plus 10, which is the total of the rams to be sold, 50. Okay. The sales is 500,000. All right. So the sales is 500,000. The cost of sales, the 50 at price of 7 is 350. So my gross margin, I'm expecting 150. Operating expenses, selling, admin, and rent, it's 75. The depreciation, I assume 25% of assets, which is 1,000, assuming. And the operating income, the EBIT is 74,000. Now I have that financing cost I have to pay for quarter one, $4,000. I get net income, $70,000. This is not a real income statement, but this is a profit planning. I plan for the future that I am gonna get profit $70,000. Okay?
Okay.
All right. Most of the time, forecasts are not met. Most of the time, accountants start analyzing variances. Is it favorable or adverse? Is it plus or not? And tell me why. Why we did not meet the target? Because, well, we have got COVID. Why we did not meet the, well, we have waste. Why we did not meet the target? Our people were sick. They did not perform well. Our machine got defective. We will know where is the problem. We'll try to rectify it. This is called the forward thinking and how to meet your targets. Now, the cash planning. We all know that the profit that you planned is not really cash. Correct. So we have to calculate the cash. Why we do calculate? We forecast the cash. We forecast the cash because of one simple reason. If next year I'm not gonna have good cash, that means I should apply for a loan in the bank right now because this process takes time. Is it understood?
Yes.
That's why I forecast the cash. Thank you for saying yes, for answering. We forecast the cash because if we are expecting good cash, we don't want to get loan. If we are expecting low cash, that means we have to plan and start with the loan right now because it will take us 6 months to get the loan. Because if we did not start right now and we got low in cash, we will have difficulties in paying our shareholders, we're paying to meet our obligations. Let us process it from now because things takes time. Now, there is uncertainty. Everything is uncertainty. You have other theorists, they will say budget is scrap, is really a crap. Really something not usable. Why? Nobody knows the future, which is true. However, still companies, they prepare budgets. It's a process that it helps coordinating activities between departments. It helps setting targets. Any salesman, I'm 100% sure that one of you is a sales guy and they will tell him your quota for next year is 100,000. For the quota, your quota for the following year is 120. They will increase the quota. Why? They want him to run. And that's why they prepare the cash budgeting. They prepare the budgeting itself. Okay. Now, how to prepare the cash budget? Let us take an example. Noura has in the bank $1,000 in November. In November, she has cash, $1,000 in the bank. Noura. I owe Noura an amount of $3,000 and all debt. She asked me for her money, and because of the pandemic, I promised her to pay it in installments, 33% every month. So we are in November. I told her I will give you in December and January and February $1,000 a month to pay back my debt to her. Can Noura draw a cash budget, a cash planning, cash budget? Because she is planning to buy a new set of cosmetics in March. Can she do that? Guys, I'm asking. Should I say it again? Hello?
Yes, she can do that by
Yes,
the
she can.
turn the 100% almost.
Yes. Let us see how the cash budget is being prepared. Look at this figure. Since she has in the bank in November 1,000, we will start with November. And she has a target, we will end in March. So in November, the expected cash receipts in December is 1, in January 1, in February 1. Now, the beginning cash in the bank, she has 1,000, and the ending cash in November, she has 1,000, because the beginning is the same as in ending. It's in November, it is in the bank. Now in December, she is expecting 1,000. So the beginning cash in December is 1,000. But the ending cash in November is 1.
4,000.
No, in December, she will have 2. The one
2,000.
in the bank, exactly. The one in the bank and the one from December, 2,000. Now, in January, she has 2 as beginning cash, and she's expecting from me 1,000. It becomes 3,000. And this 3,000 now become the beginning cash. In February, expecting another 1,000, to have 4. In March, it has 4,000, and she can buy her cosmetics. You check, did you see how the cash flow goes? The beginning cash, you are expecting some, it will become ending, and the ending become beginning, blah, 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 blah. It's very easy, straightforward. Is this clear?
Yes.
Yes. Okay. Look at this example. If you finish this example, that means we are okay for this session. Gulf Industries is a defense contractor, is developing cash budget for October, November, December. She wants to prepare cash budget for October, November, and December. Now the sales of August and September were 100,000 and 200,000. The sales of 400,000, 300, and 2,000 have been forecasted for October, November, December. So in October, November, December, they are expecting sales as 400, 300, and 200. In August and September, they already have sales of 100 and 200. Historically, what the firm does, she got 20% of the firm sales as cash, 50% collected after 1 month, and the remaining 30% after 2 months. Okay, in December, they are going to give dividends 30,000. Let us see how they will draw the cash budget. Look at this, very easy. In August sales, it's 100,000. In September, 200,000, right? But look at the example says, historically, 20% are cash. Fine. 20% of this cash is 20 collected. And the 50% of this 100 is after 1 month, which is in September, it will be collected 50. And 30, yeah, tell me. So,
Yeah, no, sure.
Tell me, please. I'm not hearing well.
The slide was not showing before. Now, okay.
Now, okay. Now, I'll then, if the slide's not showing, now I will restate again. In August, he is getting 100,000. However, in August, he will get 20% of this 100 in cash. So we put 20% as cash sales. But he will collect this 50% of this next month, 50% of this 100 next month, it's in September. 30%, the remaining 30 after 2 months. So in October, he will get. So the 100 is divided into 20 and 50 and 30 because he's normally, historically, 20% cash and 50% collected after 1 month and the 30% collected after 2 months. So August, September, October, we got the cash here. So we have the cash in October. In September, we have the sales is 200, and we have got the 50 from the 50% from the previous month. And in October, we have 400 sales expecting. So we got cash sales from the 400, 20% from the 400 is 80. And this 100 is the 50% of the 200. And this 30 from the 30% of the 100. Did you understand the figure?
Yes, yes.
Yes.
Exactly. So all the way, you will get the receipts you are expecting in October, 210,000. You are expecting in November, 320. You are expecting in December, 340. It all depends on your rules and regulations. 20% cash, 50% after 1 month, 30% after next month. So you put the cash in which month you are expecting the cash. All they come from the sales figures. Okay, that's why we start with the sales. And this is the receipt. And on the payment, exactly this is the purchases. Okay, the purchases, that means that you're gonna pay, you're gonna buy. All right, we plan for the payments. What the example says, the purchases represent 70% of the sales. 10% will be paid immediately in cash. So 10% of the 70% of sales are in cash. The 70% paid in the month following the purchase. And the remaining 20 is paid 2 months following the purchase. Look at the expected payments. You got sales purchases of 70. So 10% from the 70 is $7 expecting you to pay cash. And 1 month, 70% after 1 month you pay of this 70, 49, and the remaining 20 of this 70 you are gonna pay 14 after 2 months. And all the rest the same thing, you will get the payments. So the October you are expecting to pay 213, the November expecting to pay 418 in cash because we are planning the cash. Okay, now the receipts minus the payments, we will get the cash. There was instability. Was I clear?
Yes, yes.
Okay. Final step, receipts minus payments plus the beginning cash balance. You will get the cash flow of for your cash budget. So total cash receipts 210 October, November, December 210, 320, 340. Total cash disbursement means payment. You're gonna get 213, 40, 418, 305. The net cash is October you have $3, 98 and 35. But you will add the beginning cash, how much you have in the bank originally. You have 50. Then you lose here between brackets, that means negative. 210 minus 213, it's $3 negative. So you have debt, you don't have cash, you owe people $3. So you have in the bank 50, that means you have cash 47. This 47 in November, it will be your beginning cash. And you already have lost, you have to pay 98, you have cash 51 negative. And then you have in December 51 negative, the total is 16 negative. That means this company, Gulf Industries, She will not have enough cash in December. What she will do right now?
Loan.
That's what is cash planning helps us do. It will help us, well, our expecting of sales and our history of collecting money leads us to this cash budget, which is negative. Let us get some loan in order to perform much, much better. Okay, I believe this is the end for this session. We finished at 9 exactly, at 10 o'clock your time. And I hope it was clear to you. I'm 100% sure, guys, you will not understand, grasp the figure exactly as I do, or 100%. Why? Because this science is new to you. However, you got an idea how things are being calculated, what are the jargons used, how they perform, analyze companies, how they prepare forecast planning, how do they do this and how do they do that. You can read the financial statements, you can read the income statement, you can analyze the performance of the company, and you know how do they prepare the cash flow. Is this clear to you?
Yes.
Yes.
We are done for tonight, for this session. Thank you very much for attending, guys. And I'm extremely sorry for this 2-3 interruptions, have got disconnections from, I will sue my internet provider. Don't worry about it. Next time it should be better.
Thank you.
No worries. Thank you.
Good night.
Night.
Good night.
Thank
I
you.
will,
Good night.
thanks. I will upload, by the way, I will tell Sally to upload the other modules, okay? And the assignment, we will discuss the other modules, and the other modules are a bit easier than this one, by the way. Okay?
Okay.
Keep tuned. Bye-bye.
Thank you.
Thank you. Bye bye.
Thank you.
Thank you.
Thank you.